You are listening to Keystone's Stock Talk Podcast, episode 158. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. After a brief hiatus spent testing a new video format for this podcast, we are back. Now, video podcasts should be available starting next week on YouTube, so stay tuned. If we can get them to you, we'll let you know. This week, we start by discussing my recent research trip to LA at the Fall LD Micro event. Next, we will introduce topics for our new series of live webinars upcoming. In our first Your Stock Our Take, Brennan digs into a listener question on VirTra, symbol VTSI on the NASDAQ, a provider of judgmental use of force training simulators, firearms training simulators, and driving simulators for law enforcement, military, educational, and commercial markets. In our second Your Stock Our Take, Aaron takes a look at Alaris Equity Partners Income Trust, symbol AD.UN on the TSX. A royalty streaming company that provides alternative financing to smaller mid-market private companies in exchange for ongoing royalty payments. The stock yields over 7%, and Aaron lets you know our take on its current valuations. So let's get right into the show. I'm going to welcome my co-host, Brennan and Aaron. How are you guys doing?
Doing well. All right. Yeah. So we did, as you said, we did try out video format for the podcast earlier this week. It's something that we find interesting, and we want to transition the podcast to a video format. We could have come up with it this week. I don't want to point fingers as to who.
I know where this is going.
Where the problem was, but it was definitely Brennan for sure. Yeah. So we can all thank him. Now,
something to do with
some people may look at this differently.
Internet.
Some people may say, "Thank God for Brennan." Now I don't have to look at Ron and Aaron's faces,
True.
But others would have wanted to see us. So.
I don't know.
Yes, it's nice to put a face to a voice.
Yeah. I guess the
explain your download or upload speeds.
What happened? Why I'm getting all the flack, everybody, is because my internet. It's subpar. I only have the copper lines at my building rather than the fiber optic. So the last couple of days I've been. Just getting nothing but trashed by Ryan and Aaron. Out in Saskatchewan here, we don't get nothing but only the copper lines. Just kidding. We do
basically,
get
Brennan is still on dial-up. Let's be honest. He's still on dial-up. You hear it. And then
but Aaron isn't wrong.
It's impressive.
Aaron isn't wrong. It was my fault. We recorded the podcast. We were all suited up. We were looking good. And, it just didn't upload.
Well, I agree, Brennan. Your internet is subpar, but that may be.
Yeah, we recorded it 2 days ago, and it's still uploading right now, so it may come in sometime in the new year.
Doing anything on the internet with Brennan is like taking a time machine back to the 90s.
Whoa!
We're upgrading him, so hopefully he gets some high-speed internet. Maybe we'll go to satellite. We'll go up into the satellite. We'll bypass all the traditional copper wire that's in the ground that's trying to power his internet and get him into the at least into the 20th century. Are we even in that century? I can't even remember. Let's talk about that research jaunt I went on, the LD Micro event. I'm going to summarize this, then you gentlemen can ask me a few questions about the event. So the LD Micro that I was at, there was around 200 public companies, our stocks, 500 to 600 analysts. Each company gets about 20 minutes to present. And the analysts, such as ourselves, can book one-on-one meetings with the management teams. We review all the companies in advance and book meetings with the teams we think could potentially enter our coverage. So there were some good interviews. In the past, we've met, not for the first time, but you meet them after they're in coverage. Companies like Expel, Viamed, Zynex, Acme United, Sangoma at these events. So, it's a good quality event. Essentially speed dating management teams, get 25 minutes with them face to face. So that's a very valuable thing.
Excellent. So this event, this is the first in-person event, Ryan, that you've been to since the start of the pandemic. You said, 200 companies? So normally we're looking at about 500 companies. So obviously not as many names, but what were your feelings in terms of opportunities there? Were you seeing anything that's interesting?
Yeah, there was some that were interesting. Like you said, you get 200 companies versus 400 to 500 and 500 investors versus 1,500. It's a smaller event, and we can understand why given the times. But so we usually do, if it's 500 companies, we're going to maybe have 25 to 30 that we might watch a presentation from, and then maybe 20 of those we could do interviews on. So it's less than half of that this time, but it's that's just because we need so many companies to really pull out a number that meet our criteria. It was good, like I said, to actually sit down across from the table for management, a few select management teams there, and get to know them, get to know their businesses a little further. This is very valuable, and I'll tell you why. When we do these events, we're usually doing 4 to 5 a year that the similar type management teams are coming to. So if you sit down in front of the team, interview them for 25 minutes, say at the end of it, it'll be great to see you. We'll see you in 3 months at the same event. They typically, they're typically going to be more straight shooting if they know they have to sit in front of you after their next quarter and answer the same type of questions. And there'll be hard questions if they missed on, estimates or anything like that. So that is the way we find it valuable. I'll give you an example. Like we've sat down with the team from Expel 4 or 5, 6 times in person now. You really get to feel for the quality of the management team behind these businesses. You want, it's the intellectual capital behind these firms. You're putting your hard-earned dollars, our investors are, or we're putting our hard-earned dollars to work. It's nice to know that these are good quality teams behind the businesses. And on the flip side, it's nice to know that when you're interviewing a team, if they turn out to be, less than high quality, the numbers might look good, but you might not trust that you want to put your dollars into that business. It's just a good thing to be able to sit down and look at to see if you want to put your dollars in these management teams' hands. And, it's better to do that if you're in person, in our opinion, than it is if you're doing just a regular phone call or even a Zoom call or something like that. So that was valuable. We did sit down with some teams from our coverage. We sat down with Acme United, had a good update from them, and we've been talking to them online over these events. But we got to sit down with the CEO, the founder of the company, and just shoot the crap, right? Just find out where the business was, where the supply chain concerns are, what we think is coming up next quarter, how the business is going to grow over the next year, 2 years, 5 years out. And, we got to immediately put out an update on the business, and we actually upgraded it in our coverage. So those things are valuable to be able to sit down and do. Overall, good to see some people that, we know in the industry that haven't been able to see for a couple of years. And hopefully we think there's going to be an event like this in 3 to 6 months that will have, maybe 300 to 400. So increasing the volume of companies there is going to probably increase the meetings that we can have and the good research that we can pull out of those events.
Well, I know typically in any given year, back when we were going to the event, when there's 500 companies, we might find out of that 500 company list, maybe 25 to 30 companies where we think it's even worth it to look at the presentation or give it any additional research. And typically less where we think it's worth it. We're at the point where we would actually sit down with management, maybe 15 to 20 meetings out of that. So it's nice to see, obviously, more companies, but it really comes down to quality over quantity, right?
Yeah, and like you were talking about last year in the virtual event at the same time, we pulled out a couple recommendations, Acme, United, and the other one is IEC, and you can let like the listeners know what happened with that recommendation.
Well, IEC, underfollowed micro to small cap electronics manufacturer in some specialized areas like healthcare and defense. We, good profitability. We thought that it was growing. We thought that it offered good value. So it was recommended in the fall of last year from the LD Micro Conference. And it was just recently taken out at about $15, and we recommended about $9. So that's essentially the type of opportunity that we're looking for when you go to an event like the LD. And then of course Acme as well. Another recommendation out of the conference last year, very staple business, decent growth at the time, good valuation, and, has performed extremely well.
Yeah, I think the three companies, Acme, IEC, and I believe Sangoma was re-recommended then after the event. And, Sangoma has done really well, had a transformational acquisition since the last fall. Acme, like I said, done well. IEC was taken over. So we had three good results. We will be likely including a couple companies in coverage upcoming in our larger NASDAQ report, where we looked at every company basically with market cap of $2 billion or less. And there'll be a couple of companies that we interviewed at this event in that report upcoming. Yeah,
and so we're
excited to put that out for clients over the next 2 to 3 weeks.
Yeah, and like I want to add, now, from that report, sorry, Ryan, just before you go into that,
no problem.
We had 3 recommendations, like you said, but I like that, we even highlighted a few stocks where, seem very interesting, great fundamentals. Maybe they're a little bit too thinly traded. Like just a couple, like Mama Mancini's, good company, very interesting. I believe it's performed very well
over that time.
Leet Corp, another stock that, when we were looking at it, we thought that maybe it was a little bit too niche and maybe thinly traded. Leet ended up going, it was one of, my most interesting stocks that we were looking at that time. Leet ended up going from 2 to I think about $24. Now again, it wasn't a recommendation, but we saw that the fundamentals were strong. Risk might have been
that's what we do. We narrow down. We'll highlight and do mini reports on like 20 companies, and they'll likely in this larger report be almost over 30 mini reports that we're doing in it. That are companies that are close on our monitor list. The value that provides to clients is if they see one of these companies, they can read through a page mini report on that. If they like those investments, they can ask on our chat if it suits an investment, if I like this, and we can let them know further on that. And it also shows them essentially what we're monitoring. And it gives you an idea. If we looked at, like in this larger report, we're looking at 3,800 companies. And if you're doing mini reports on 30 of those companies, literally those are what we think are the best 30 out of 3,800 companies. So they've really passed a lot of screens already, and we may pick 3 to 5, say, actual recommendations out of that. But even the 20 to 30 that we have in mini reports are certainly heads and tails above the other companies that we see when we do that full review of the 3,800 companies. So, we're more comfortable buying those than about 3,700 and some odd that we look at on the full list. So they've passed a lot of criteria already. Okay, well, let's get to we're really excited to announce our next set of live webinars. They're called How to Position Your Stock Portfolio for 2022 and Beyond on November 2nd and November 9th. The November 2nd live webinar will be 7 p.m. Pacific, 10 p.m. Eastern. November 9th, 4 p.m. Pacific, 7 p.m. Eastern. I don't just say this, it's happened every time. This event will sell out. So I encourage anybody who wants to come, claim your tickets while they're still available. Now, if you're looking to fix your existing portfolio, take the plunge and build that simple 15 to 25 stock portfolio consisting of well-researched growth and dividend stocks. Don't miss it. Get those tickets. We'll talk about our simple plan, 15 to 25 growth and dividend stocks that you can build over a 2-year period. Save you money. It's designed to enrich you, not your advisor. Save you on those fees. We're going to give you stories about how 2 to 3 great investments can change your life. Talk about the Boyds and the Expels of the world. Good, solid, showing how successful companies that we've invested in the past, how we can follow that trajectory again with existing recommendations, finding the next Boyds, the next Expels, and how they can impact your portfolio. Going to give you 7 stocks you can buy right now. Our top REIT, our top SaaS tech, top disruptive healthcare stock, our health tech stock, top FANG, top gold related, dividend growth stock, and more. We're going to talk inflation in your portfolio, China, and why we avoided this market. We're going to explain briefly the NFT craze, whether it's an opportunity or bubble. This time last year at our seminar, we reviewed all the FANG stocks. We're going to do that again. So revisiting Facebook, Alphabet, Amazon, Apple, Netflix. Are they overpriced, fair valued, or undervalued? We recommended Alphabet as our pick of the litter this time last year. Performed tremendously well out of that group, up 80% over the past year. So we'll have another top pick from that segment. There's some huge news out today. Snap, the social media app, was down about 25% after market today, after they were affected by the iOS or Apple's iOS 14 new privacy rules that were put in. We'll look at how that'll affect Facebook and Alphabet. Likely less Alphabet than Facebook, but we'll tell you why we believe that going forward. Learn to take advantage of tax loss selling. I'm really excited about this. We're going to talk about what tax loss selling is, why it can produce extraordinary opportunities potentially this year in the small cap segment. We had a huge run up in the small cap sector, pushing valuations well beyond likely where they should have been in March of this year. We're going to tell you why that might produce some babies getting thrown out with the bathwater in December, and there may be some real opportunities there, about 10 to 25 stocks that we're monitoring. And we're just, go on, talk about why cash flow matters in your portfolio. And then at the end, 30 to 40 minutes Q&A session with myself and Aaron, answering any questions on the strategies we talk about and the stocks. So there's a lot packed into 3 hours.
And I think that, Ryan, the two of us have been doing this for 20 plus years, right? So we've seen a lot in the market. Time. It's been a while. We've researched thousands of companies, made recommendations, decided not to move forward on many, many thousands of companies. And really what I see this DIY seminar as is us identifying some of the most important lessons that we've learned over this period of time that we can then relay to the listeners, to other investors, and whereby they can take that and use those lessons as tools and actually apply those tools to be able to make the best investment decisions and do the best things for their portfolio. So it's really, us summarizing what we learned in 20 years and some of the most important principles of investing.
Yeah. I think
and of course, did you mention the starter portfolio at the end? Usually typically 5 or 6 individual recommendations at the end that are essentially will allow somebody to start building that portfolio, that profitable growth oriented portfolio.
Yeah, so we're excited to get to it, and we're excited to see everybody there.
Yeah, I'm excited for the tax loss selling. It is interesting that really I haven't seen anybody talk about it, but it's very, very true that we've seen this run up in small caps. And, there are going to be a lot of losses, people taking positions at elevated prices. And, it's interesting. I'm excited for that segment, for you to kind of dive into that. Being a new investor, I know what tax loss selling is, but, I don't really know, I guess how to utilize it and whatnot. So,
and there's certainly some companies that will be sold off that I wouldn't touch with a 10-foot pole. Sure. And you got to you don't want to sell because a company is down, or buy because a company's down from an all-time high or something like that. You want to find those companies that maybe got pushed beyond where they should have gone fundamentally in terms of valuations by some euphoria in a segment, and now are trading below or may in that period, that 3 to 4 week period in December, maybe pushed well below where they should be, and then they can have a bounce back to start the year when people stop losing their heads and are investing based on the fundamentals, which it eventually comes back to. So you could get an opportunity. It's not guaranteed, but in the past we've seen this as a period where you can pick up some good businesses, potentially 10 to 50%, 15% below where they should be trading. And then, you can have that immediate pop up to normalize the valuations. And then as they grow over time, they can do well in your portfolio. If we'll discuss how to do that, why we do that, and where we should be looking at what particular companies we could be looking at as well. So that should be interesting. Now let's get into your stock, our take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. We got a question that came in from Jeremy on VirTra, VTSI, and the NASDAQ. Brennan, you've been tasked with this one.
Thank you. So VirTra, VTSI on the NASDAQ, currently trading at a price of about $8.92 and a market cap of $96.2 million. So the company is a provider of judgmental use of force training simulators, firearm training simulators, and driving simulators for the law enforcement, military, educational, and commercial markets. So essentially, the company has had a few additional contracts that they've brought on recently. I just will touch on two of those. So the first is on September 16th of 2021. They received a $1.37 million order from a country in the Middle East for the use of force simulators and various training tools. And the other was on October 5th of 2021, of course, where they received a $1.3 million order from a federal law enforcement agency in a European country for use of force simulators as well and weapon recoil kits. So looking at the financial results here, revenue was up 90% to $5.3 million compared to the same quarter last year. They say that the increase was attributable to an increase in the number of simulators and accessories that were delivered. I also believe that they did have a relatively weak Q2 of 2020 just because of the pandemic and everything kind of slowing down. So keep that in mind there when we do see that growth. Net profit was $530,000, up from a loss of about $600,000 in Q2 of 2020. And they've got a very nice balance sheet, $21.5 million in net cash. So we like to see that. And on a trailing enterprise value to adjusted EBITDA multiple, they're trading at about 13.5 times. So, not too bad, I would say, but let's look at the growth a little bit longer term here. So if we look from 2017 to 2018, we saw revenue grow at about 10%. From 2018 to 2019, we saw a growth of about 3.3%. And then from 2019 to 2020, about 2%. So growth hasn't been, phenomenal realistically. We're kind of in the low single digits here. So if we're looking at that enterprise value to EBITDA, and those historical growth rates, maybe it's trading at fair value. That is kind of the thought here. But of course, we do need to look forward. On a positive note, the company did say in their last quarter that they had 19% year over year increase in its backlog to a record of 17 million. So, growth going forward does look sort of promising based on this. So that's kind of nice to see. So our take, to sum it up here, in my opinion, VirTra is the antithesis to what many people were calling defund the police. I personally believe that police could use more funding which could be used to purchase VirTra's simulators and training devices so that officers on the front line are fully prepared to respond to any situation. Fundamentally, the business is strong with solid revenue growth this quarter, decent growth over the last few years in the mid single digits, as well as record backlog, which could support attractive growth going forward. We'd have to dig into that a little bit further to really see if there will be growth going forward. As well, the business is profitable. They've got a cash-rich balance sheet and, a reasonable enterprise value to EBITDA multiple of 13.5 times. So it's not too bad. But we would like to see maybe the growth a little bit higher there. So considering the business's low growth from 2018 to 2019 and 2019 to 2020, right now I believe the company is trading near that that fair value mark unless we get an indication that the company is going to be able to ramp up growth into the mid double digits. But, all in all, it's definitely a story I will continue to follow and dig into further. I think that it's, kind of an interesting play, on just the training for the police force that I believe that, is crucial. And like I said, it will be interesting to kind of dig more into the growth profile going forward to see what they are anticipating.
It's I think that you're actually 100% right, Brennan, although it pains me to say it. But
Thanks.
Certainly, I mean, when I'm looking at the fundamentals of this business, it's certainly they're in an interesting market. I agree with you. I think that a solution is more training for police, not less, more resources, not less. So this is a company that could fill that potential demand, profitability, good balance sheet. As you said, though, the only thing is that it's not been a great growth stock in the past. The last quarter was strong, but I'm thinking that, compared to the second quarter of last year is a pretty easy comparable. But this is the type of company, certainly, I think it's worth monitoring, maybe even ready for a call to management to learn a little bit more about the business and see what the opportunities are for accelerated growth in the future.
Yeah, I think it's a good summary of both your parts. In terms of, there's been some growth. If you go back to like 2011, about 8 million in revenues, trailing now to 22.7, but that's, almost 10 years. It is 10 years. We'd like to see a little bit more growth in that. Is this an inflection point is what we'd like to know, or is it some pent up demand? Those would be what we'd reach out to management and ask them about. And given the valuations on the stock right now, we'd like to hope that if we wanted to make an investment, it was an inflection point and the growth rate is going to ratchet up from here to justify those valuations going forward, and then smooth them out and bring them lower to the point where, we've made a good buy. And those are the things that we'd like to know from the business right now to see whether it would add value to a portfolio right now. So our second Your Stock, Our Take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Is on Alaris. The question is, can I get your opinion on Alaris? It pays a nice dividend, which recently increased. Is this a good income investment? It's from Doug in North Vancouver. Thanks, Doug. Aaron has been tasked with this one. He knows the business well. I do note that the symbol is AD, or Aaron Dunn, and then UN. I don't know. It almost says A Dunn to me. So
that is sort of spooky.
I can see your affinity.
I never
for
noticed
this company.
That's true. That's amazing.
Well, I look at it, and I said that to Brennan earlier.
Maybe I need to spend more time researching the company then.
It's calling out to you, Aaron.
A good sign.
It's calling out to you.
But we'll focus on the numbers and not the not how the symbol resembles my name. So
numerically, not numerically.
Okay. Alaris Equity Partners, as Ryan said, the symbol is AD.UN. See, I'm almost saying my name. AD.UN.
I screwed you up big time.
You did, but I'm gonna get back on track here. So it trades right now at a price of about $18.50. It's about an 835 million market value company, market cap, and it pays a very attractive yield right now of over 7%, 7.1%. So what does Alaris do? Alaris is a royalty company. They provide alternative financing to smaller mid-market private companies in exchange for an ongoing royalty payment. Alaris currently has 20 royalty streams from a diverse range of businesses spanning multiple different industries, including utility service, IT consulting, construction, even a fitness gym, just to name a few. Over its history, this company has invested about $1.8 billion into 33 different royalty streams. And the way the structure works is that Alaris provides capital to private businesses that need this money maybe for liquidity, to fund growth, or even to recapitalize. The private business pays Alaris an ongoing royalty payment for an indefinite period. Typically, this is linked to the revenues or the net profit of that company. And if they ever want to end that royalty payment, then there's a contractual buyout that they will also have to pay to Alaris. So overall, Alaris's existing portfolio is generating a baseline cash yield of 13%, so about 13% return on investment. Alaris uses this cash flow to pay an attractive dividend to its shareholders. As I said, it's yielding over 7% right now. And this company did pay a generally consistent dividend over a time span of many, many years. However, in June of 2020, Alaris did reduce its dividend from 41 cents per quarter to 29 cents per quarter due to the business disruptions that were experienced by its investees during the pandemic. Since then, there has been some recovery. The dividend has been increased twice, is currently 33 cents per quarter. Right now, the payout ratio based on run rate distributable cash flow is about 55 to 60%. So that's very reasonable. And in June, the company also announced a new investment of $70 million into a new royalty partner. And the management believes that this investment is going to increase Alaris's distributable cash flow per share by about 6.5%. So recent financial performance has been strong. Q2 revenue was up 37% to $35 million. Cash flow per share was up 18% to 45 cents per share. The recent growth was also largely a result of recovery from lower performance last year. Comparing against Q2 of 2020, that's a relatively easy comparable for the company. So we're not expecting to see 37% revenue growth on a go-forward basis. So just going a little bit deeper into the financials, and I have actually looked at this company many, many times over the years for our income research because it is such a high yielding stock. And an important metric that Alaris reports is something called Partners Earnings Coverage Ratio, or ECR. The ECR is essentially the multiple of an investee's annual earnings to the annual royalties that it owes to Alaris. So for example, if one of Alaris's royalty partners was generating $2 million a year in earnings and is contractually obligated to pay $1 million a year in royalties, then the ECR would be 2 times. So this metric is used to measure the financial health of the royalty partners and the margin of safety between earnings and royalty obligations. A higher ECR indicates better financial strength and lower risk, while a low ECR can be an indication that a company is close to not being able to make its dividend or its royalty obligations. Alaris reports that 11 of its partners have an ECR of less than 2 times, and 9 of its partners have an ECR of greater than 2 times. So what is my take on the company overall? Well, overall, I think that Alaris is a very interesting business. I always have. It has a long track record of paying out significant dividend income to its shareholders. It's attractively valued relative to cash flow. Right now, trading at a price to cash flow ratio of about 10 times on a trailing basis, probably less if we look forward to what the company is likely going to produce over the next year. The outlook is generally positive, and there's been some investment into growth as well. However, I do consider this company to be higher risk, and I do have some concerns. The first is that I find it very difficult to get any information on the companies that Alaris invests in, the royalty partners, as these are generally all private businesses. The information we have from Alaris is generally restricted to the earnings coverage ratio, and I've always considered the earnings coverage ratios that have been reported to be quite low, indicating higher risk. So the majority of the company's royalty partners, as I said, have earnings coverage ratios below 2 times, which I personally don't believe provides a lot of coverage. 9 of the companies have ECRs above 2 times, but we don't know how far above 2 times. We only know that it's above 2, so it could be 2.1, could be 2.5. These royalty partners are also paying average yields of 13% on these investments. This is expensive considering how low interest rates are currently. So these are businesses that clearly aren't able to access bank financing or debt at lower costs, and that's why they have to resort to an alternative financing structure. We really have to consider the reasons for that, and this really implies a higher level of risk amongst these companies that they have to pay such a high rate to get access to capital. Looking at Alaris' stock price, it really has not done a lot over the past 10 years except move up and down. It's been quite volatile. So it does appear that the market is recognizing some of this risk. Now, this does not mean that I think that Alaris would not be a good investment. I think it has a lot of very interesting attributes. investing in private companies the way they do, there is risk associated with that, but they do have a diverse portfolio, which should help to balance off that risk exposure. The fundamentals look reasonably strong right now, and it does have a long track record of paying dividends. I would just remind investors that this is a higher risk company. If you wanted to invest, make sure you set that the amount of capital that you're investing into it appropriately relative to the risk. I personally wouldn't make Alaris a core position in my portfolio as a higher risk dividend play that has a pretty good track record. It certainly has some merit.
Yeah, I think it's a good summary. When you look at a number of the metrics make it look like an attractive investment potential. But like you said, and you mentioned, we've always kind of looked at it this way, that royalty financing is expensive, and you often can question the quality of the business that has to go that route for funding. There are some that do it well. In the past, we've seen some other investments, other companies, public companies and non-public, that fund this way. And, the best parts of their portfolio, the best investments that they make, often are able to buy out the royalty. And then, you end up with the worst parts of your portfolio staying on in the long term. You'd like those successful ones to not be able to buy out that royalty and keep it on. So if it's always riskier companies, and the best companies can go a different way in terms of their financing, then, it is for us, what's the quality of your portfolio? And that maybe, I'm not saying Alaris specifically, but does that make these type of companies higher risk? And Aaron is saying, there is some risk there that you have to take into account, and probably, the reason why the valuations look quite attractive.
Yeah.
So
I think that's a really good point. And, and that is something that you have taught me. We were looking at a renewable energy streamer. I can't remember the name. But, basically we were looking back, and some of these streams were getting bought out, and I was like, oh, well, isn't that a positive? But it's no, I mean, like it's
it's positive good, short term,
exactly,
and the ROI on those investments looks great and everything. But, to build that business over the long term, you'd like to see that royalty be perpetual, right? Continue. And as that business grows and continues to grow its cash flow, that royalty grows. But if they just get the chance to 3 years in, because they are doing well, buy you out, then, that business gets what was a good investment, and they get a good return on it. But it's not, it's like a business. This is a little different, obviously, but it's like when you have a contract business, you can win some good contracts. But then when that contract runs out, you have to keep backfilling that in the business, versus like a SaaS company would be like a perpetual royalty, if we're going to put those two together, where you get that royalty, and the better that business does, the better you do over time. You get that SaaS contract. If you continue to deliver on it, it just keeps churning in cash flow over the long term. So, I mean, that would be likely why the valuation is not the highest on that, because, you can have this situation in some of these royalty companies where the best investments they've made and the best royalty they got off companies end up buying them out over the long term. That's why there are some streaming royalty, like gold related companies, that they have a perpetual royalty. Well, that's more attractive to us.
Exactly. And I'd even like to relate it to like a callable bond. Like it's like a call, like that is like a call on a bond is to the detriment of the investor. And a callable bond is always going to trade at a discount to a plain vanilla bond. So, I mean, it's kind of the same thing. Yeah. I just, thought of that analogy. I mean,
you get that one, like with these, when they're paying back the royalty, you get that great one-time payment, but then you have to deploy that capital, and you have to go out and find, and I think it's difficult to find great companies that are, need a royalty structure, or will go with the financing through a royalty structure. So once you found it, you kind of want to hold on to that. But if they have the out clause to buy you out, then you're continuing having to backfill that portfolio. And does it lead you to a portfolio where the companies in your portfolio that continue to need those royalties, they might ask you for more and more, so your portfolio gets skewed towards sitting on the companies that aren't doing as well, because they can't buy out their royalties, because they probably consider the royalty a high cost funding. So if they could, that's likely they're doing well, and then they get rid of you. Anyways, that's I'm not saying that's Alaris, but generally the structure for me, that are the worries that I have over the long term with that structure.
And I just wanted to...
You don't have like a perpetual royalty. If you have a perpetual royalty, it's a different story.
Exactly. And I just wanted to bring that up because that is something that, I've definitely, like, that's ingrained in the back of my head now. It's a good thing to always keep in mind when you're looking at these royalty streamers.
Mm-hmm. Okay, and that's all we have. Aaron, anything else you want to add, or are you good?
Oh, I think I'm good. Add to Alaris?
No, to anything.
No, I'm good. Just looking forward to life
generally.
I think just looking forward to the upcoming DIY events, and also I'm going to be speaking on the Money Talks Uncensored podcast this Saturday. So tune into that.
We should have said that at the start of the podcast. Yeah, Aaron's going to be on this Saturday on the Money Talks Uncensored podcast. So go to iTunes or wherever you get your podcasts, sign up and listen to Aaron. We'll send out a notification of it and a link to it later, but go sign up for that podcast. Hear Aaron on there. He'll be talking, the markets, talk about a couple of individual stocks likely, how maybe inflation affects your portfolio, whatever the topics they get to. He might even touch on some of the things we'll be doing in the webinar as well. So listen to Aaron on Money Talks with Mike Campbell. It's always a good interview. At least Michael's there and you can stomach Aaron, right? So it should be good. I'd like to encourage everybody to keep adding us, this podcast, to your iTunes. Rate and review us on there. Hopefully you say some nice things, but say what you want to say. But just rate and review us on there. Keep your questions coming into our Your Stock, Our Take, or Ask Us Anything. If you want us to compare two companies, like industries, see which one we think is a better investment, we can do that. And I'd like to wish you, as always, profitable investing. Thank you.
Profitable investing.
Thanks, everyone.